Recently, markets have been trending down, and I expect they're going to continue to trend down and possibly even make new lows. And there are a few reasons why. Now, the reason we've seen this recent weakness in the market, and I expect we're going to continue to see it, is all because of the government bonds and treasury market. Now, if you don't know what government bonds are, it's essentially a debt instrument where when the government needs money, they decide to borrow it from investors, institutions, whoever will give them money. And in return, they pay out a yield, which is, the yield on a bond. And that yield is an interest rate. And at the end of the term of the bond, say it's a 5-year bond, at the end of those 5 years, they pay the money back that they were initially given, plus the interest rate that was agreed upon when the bond was purchased. Now, markets have been falling because the yield on these US government bonds have been skyrocketing. Have a look here. This is the US 30-year bond, and the yields have been rising like crazy. Same with the 10-year bond. It's been breaking out to the upside as well. And you can see this is an inverted head and shoulders pattern it just broke out of. So this is rallying to the upside. Same with the 5-year bond is rallying a ton too. So before I get into why these bonds are rallying, we'll just talk about a bit about why it's bearish for the markets. So the reason why bonds rallying is bearish for the markets is because these yields on bonds affect all other yields in markets. So if these 5-year government bonds are rallying, then if I go to get a 5-year mortgage, it's going to be higher as well because all other interest rates in the market, from mortgage rates to rates businesses borrow at, are all dependent on the rates of government bonds. So as these bonds rally, all these other rates are going to be more expensive. And those rates being more expensive are going to slow the economy. The other thing is bonds are an alternative to stocks. So as we see the rates on bonds go up, more businesses and individuals and institutions are going to say, hey, maybe I'll buy these bonds instead of stocks because bonds are a guaranteed return. The other problem with the yield on bonds rallying is it makes the price of the actual bond itself fall. That's because the yield of the bond and the price of the bond are inversely correlated. And the way to think about that is just if I have bonds, a 10-year bond at 3%, and now the new 10-year bonds are giving 4.15%, no one's going to want to buy my bond because the new bonds are yielding a lot more money, right? And so as those new bonds yield more and more, then my bonds are worth less and less. Now, the reason why that's a problem is because these institutions hold a lot of bonds, like banks and other institutions, they hold a lot of bonds. And as these bond yields go up, the bonds that they hold are going down in value. So that's why we had stuff like the regional banking crisis, the gilt crisis, because all those bonds they held lost value, and then it forced them some of them became insolvent, some of them had to liquidate, stuff like that. Now, the reason why we're seeing all this rallying in all these bonds is because the Treasury has decided to issue a ton of bonds. You can have a look here at the tentative auction schedule of the U.S. Treasury securities. And you can see there's just a ton of treasuries they plan on issuing. Treasuries or bonds, I'll use that interchangeably. But you can see they have a ton of treasuries they're planning on issuing. Now, the reason why all these treasuries are getting issued now is because remember those debt ceiling debates a few months back? Well, those debt ceiling debates got resolved, which allowed the Treasury to refill their Treasury General account or their checking account. And they do that by issuing treasuries or bonds. And so now that it's time to refill that, they're issuing all these treasuries. And it was fine at first because they were issuing treasuries or bonds on the shorter end of the curve, mainly 1 month, 3 month, 1 year treasuries, which there was a very high demand for. But now as they're going to issue treasuries that are 10-year treasuries and 30-year bonds and stuff like that, there's been a lot less of a demand for that. And so when these longer dated bonds go up for auction, they need to be bought. So if no one is willing to buy it at the current interest rate, what happens is the interest rate goes up and up until they find a buyer at that interest rate. Now, the reason why there's been so little demand to buy these bonds is because of the inverted yield curve. Let's have a look right here. So this is stockcharts.com. We can go to the dynamic yield curve and we'll scroll to where the yield curve is right now. So this is what the yield curve looks like right here. So what we're looking at is on the left side, these are the shorter the shorter dated government debt. So this would be the overnight rate, which the Fed has set at 5.25 or 5.5%. And then as you go out here, this is the yield of a 5-year bond. This is the yield of a 10-year bond. This is the yield of a 20-year bond. And what you can see is this yield curve chart is inverted, meaning that the shorter dated debt pays more than the longer dated debt. So that's why they're having so much trouble getting the longer dated debt bought, the 5-year, the 10-year, the 30-year debt bought, is because the shorter dated debt pays more. And so what investor in their right mind would decide to risk their money for a longer period of time for less return? Normally the way it works is that you want a greater return for the longer you decide to risk your money, because who knows what's going to happen in those 10 years. Inflation could run at 5% and then you make nothing, right? And there's plenty of other risks that could happen if you invest your money for a longer period of time. So what they tend to do is they tend to compensate investors with a larger interest rate for borrowing for a longer duration. And you can see that this is what a normal yield curve looks like, right? Where the longer durations have higher interest rates. And this is just the yield curve from 2013. But so this is why we're having a problem right now with these treasury auctions, is because these longer term debt give lower interest rates than the shorter term debt. So realistically, we could have a lot more problems with these treasury auctions until the longer term debt is paying significantly more than the shorter term debt. And that would look something like, that would look something like this here, where you have the longer end of the curve higher than the shorter end of the curve. And so what that would require is the 30-year treasury to get up, near 6.5%, right? So this 30-year treasury, the 10-year treasury, they would have a lot of a way to go for this yield curve to uninvert. And all this rise in the 30-year, the 10-year is going to cause a lot of pain. And the other way the yield curve could uninvert is if we see this shorter term interest rate come down. But the problem is right now the Federal Reserve is fighting inflation. So they have that shorter term interest rate pushed all the way up here, and they plan on keeping it all the way up there. So at the moment, as long as we have inflation too high, the only way this yield curve uninverts is if these longer term interest rates go up, and that's going to be very painful for the markets. And if you don't believe me that it's painful for the markets to have these longer term bonds rally, the yields on longer term bonds rally, just look at the past. Right here, November, October 2022 is when we had the UK gilt crisis. And so as bonds rallied, it went to a breaking point, and then we had the UK gilt crisis, and then yields backed off at the thought that the Fed might, stop raising interest rates and ease up because of these breaks in the system. And then next time we had bonds rally up, we start to push the 4% level again. And then what we had after that was the regional bank crisis. So this was when Silicon Valley Bank collapsed. So you can see now we're pushing those levels again. So it's only a matter of time before we have another crisis with these longer dated bonds yields rallying up again. The real question is this next crisis going to be another crisis that the Federal Reserve can just, put a finger on and plug the leak, or is this going to be a bigger issue that's a lot harder to fix? That is still yet to be seen, but I would actually argue that a big crisis might be better for the markets, because if we have a big crisis, then maybe the Federal Reserve just, stops immediately and they say, okay, we're going to stop hiking rates. We're going to start to lower rates. We're going to start to buy bonds. And that would be better for the markets if the Federal Reserve stepped in there and started buying bonds. But of course, that would be bad for inflation. But then if we don't have a crisis, then that just lets these bond yields continue to rally. And then that's going to be difficult for businesses and stocks. So we'll see how it plays out. But thank you for watching this video. Make sure to like and subscribe if you liked it. Bye.